What's good, everyone? Max here with Stock Masters Wealthier by the day 21 and day 22. I missed yesterday, so I'm going to make one video with two topics. I'm going to jump into it. First, I'm not a financial professional. This is for entertainment purposes only. Please like, comment, subscribe. Let's jump into it. First topic we're going to cover is investing in down or bear markets. That's essentially when the stock market is trending in a really bad direction. Equities seem to continue to go down, and people get very scared and are a bit tentative to invest in the market. So we're going to talk about that and why that's when you should actually be investing in the market when no one else wants to. Second thing we're going to talk about is real estate investing versus stock market investing. What's right for you? It's going to depend on a ton of different factors. So we're going to jump into it, kind of create that dichotomy, and we're going to figure out kind of what the context is and who should be doing what. So again, please like, comment, subscribe. Let's get into it. So investing in down bear markets, when the stock market is trending in a bad direction, meaning like the indices are going down, the S&P 500 is going down, the NASDAQ is going down, Dow Jones, all of that stuff, people tend to get very scared and people want to sell out of their positions. They want to get out of the market because they want to preserve their capital. And their thinking is, well, if the market's going down, there goes all my money. But you have to think, if the market's going down and you're still holding your securities, all the market has to do is go back up for the value of your portfolio to increase again. So a lot of that has to do with almost having faith that the stock, and I obviously the stock market's pretty pragmatic and it's objective, but there is some faith that goes into it. You listen to investors like Warren Buffett, for example, and his thing is like, when people are greedy, you don't buy, and when people are afraid, that's when you buy, which is the truth, because when markets are going down, securities start trading at a nice value. Essentially, you're going to get more ROI on that security when you buy it at a lower price, because essentially maybe it's not, that's not the true price of the security. Maybe the security is much more valuable, right? That's its fair value, that's its true intrinsic value. But because of all this bad news and panic, the security is trading down here because people are afraid. And there's a lot of pessimism in the market. So basically, when the market's down, for example, right now, now's a great time to buy a ton of individual stocks, and also just like index funds and ETFs, like S&P 500 index funds and ETFs. Great time to buy. If I had more money, I would be buying as much as I could right now, because I'm very confident the stock market's going to go back up again. The stock market continually goes through cycles of bear and bull markets, and the market tends to trend in the direction that securities tend to increase over time. That's what we've seen historically. Maybe things are going to slow down a bit. Over the last 100 years, the S&P 500 has returned on average 10% a year. So maybe we're not going to see a 10% ROI every year on average, but things tend to trend in the right direction because companies become more profitable, companies merge, and there's less competition, they become more efficient, so on and so forth. So bottom line is, when the markets are down, that's when you really should be buying securities. You shouldn't be afraid to buy just because everyone else is afraid. You have to have some faith that things are going to go back up again, and they will, and they historically have. It's scary, and even though I know this personally, I'm like, oh, now's the time to buy. It's still scary when the market keeps going down. It's almost like it's going to go back up, but you're like, I don't know about this one. And I've seen it. I've only been investing for like the last 6 or 7 years, which relatively not a long period of time, but I've seen that where things are going down and then things pick back up. And the longer you're in the market, the more you're going to see those dips and those ups and downs, and you'll get more comfortable with it. You'll get more confident that, okay, it really is going to go back up. So bottom line is, when the market's down, when you're in a bear market, that's the time to buy. That's the time to deploy your capital and gather some cheap assets that you can, with some level of confidence, say are going to go up in the future. Now, the future could be 1 year, it could be 5 years, it could be 10 years. That's where it gets a little fuzzy. So if you're someone that, like me, who's I'm in my late 20s, then who cares? Like, buy them while it's cheap. It could take 10 years to go back up. I'm not going to plan on using that in 10 years. If you're someone that's a little closer to retirement age, maybe you are hedging your bets and selling out of some of your positions because maybe you need that capital. So that's a good caveat. It's all contextual, but for the vast majority of people that are 20s, 30s, maybe even 40s, it's like, don't sell out of your positions, ride that wave, because that wave is going to go right back up again. So anyways, we'll move on to the next point. Real estate investing versus stock market investing. Now, me personally, I only invest in the stock market as of now. I do invest in some REITs, but to me, that doesn't really count. That's a stock market security. I do want to personally get into real estate investing, but there is a huge barrier to entry, right? Because you need a much larger sum of capital to invest in real estate, even if you're putting a 20% down payment on a home, which typically, as far as I know, if it's a rental property, you do need to put a conventional 20% uh, down payment. That's just how it works. Ideally, you buy your first property outright, because then you don't have to worry about paying the mortgage and all these different costs. It just simplifies things. Obviously, that takes a much larger sum of capital, but that is the way to make it very easy. And I've listened to a lot of experienced, seasoned real estate investors recommend that. Buy your first property outright. That way, you don't have to deal with paying down the mortgage while you're also getting cash flow. And basically, instead of having to figure all this out and also pay a mortgage, you're just trying to figure this out, because things are not going to go as planned. Things never do. It's part of the learning experience. So when it comes to real estate investing, obviously a huge barrier for entry. Most people invest in the stock market, especially when they're younger, because it's super accessible and you don't need large sums of money to do it, especially if there's fractional share investing involved. Like you could buy $50 of the S&P 500 today, right now. At least I could with Fidelity, and it's just like, I just bought it. I can't buy $50 worth of someone's house. It's not how it works. And that barrier to entry would make you think that real estate investing may have a premium ROI associated with it, because it's harder to get into. Typically, you get a premium if something's difficult to obtain, right? That's just generally how things work. And I live in California, and I've looked at least California's real estate market in aggregate over the last 30 years, and houses have appreciated at a value of around 6.7% plus whatever you can get in cash flow. So, I mean, I would think that I could probably secure a 10 to 15% ROI on my investment annually in aggregate between rents and property appreciation, which is super good compared to the stock market. And that's obviously, that's not real ROI. That's just total ROI before inflation and taxes and all that, which with real estate investing, taxes can be a little different. That's a whole nother topic that I'm learning about right now. But with the stock market, I mean, 10% is really good. Obviously, if you're investing in the S&P 500, but with taxes and inflation, usually a 5 to 6% real ROI is that's what's realistic. So anyways, this is kind of my takeoff. Like I plan on getting more into real estate investing when I'm in my 30s and 40s, and maybe what my plan could be is I can take capital from my stock market portfolio and use that to invest in real estate. My apologies, everyone. The video cut out. Please like, comment, subscribe. Those were the 2 topics of today. I will cover one more tomorrow. Thank you. Bye.